This podcast is intended for investment professionals only. All investing involves risk.
Hello and welcome to Market Talk, where today we'll be discussing a whirlwind couple of weeks for US overseas trade policy, mixed messages from the Bank of England, and the reasons behind recent European equity market outperformance. I'm Harry Brooks, a content manager in L&G's asset management division, and today I'm joined by Bennett, head of investment strategy for Asia, who joins us from Hong Kong. Welcome back to Market Talk, Ben. It's only been a few weeks since we last caught up, I think, but it feels like one of those times when a month is a long time in markets.
It's a long time in markets. We also had Lunar New Year here in Hong Kong too, so we had a nice little holiday.
Excellent. Well, I feel like a running theme of the past few episodes of Market Talk was this constant evolution of how markets thought rhetoric might translate into reality under a second Trump presidency. At times, this focused on the possibility of deregulation, maybe spurring higher growth, while other times it was negative, focusing on potential for higher inflation or the effects of reduced levels of immigration. Now that Trump has been in office for a few weeks, how are markets feeling about his early executive orders?
That's right. So, I mean, there's different aspects to President Trump. He's a complicated character, isn't he? I think is the best way of putting it. And from a investment point of view, we break it down into 5 different elements, 2 of which are sort of negative for market sentiment or, I guess, confidence, 2 of which are positive and one's definitely ambiguous. The 2 positives, which are the ones that people focused on at the beginning, I think, are the tax cuts, the sort of higher spending, deregulation. So that I sort of put tax cuts and higher spending in one bracket and deregulation in the second. The 2 more negative for sentiment and uncertainty is to do with immigration policy and to do with trade policy. And that has had a little bit more focus since he came into power, since the inauguration. There seems to be a lot more headlines about that, hasn't there? And then there's the more ambiguous one, the geopolitics. But in terms of market reaction, I do think that there was that focus on the good Trump, shall we sort of say. This is really just oversimplified for ease, but the good Trump stuff at the beginning and a little bit more on the bad Trump now. But frankly, though, the S&P 500 over the course of this year so far, so we're talking on the 11th of February, so I'm talking to the close of the 10th of February, which is Monday. S&P is up 3.1%, which isn't a bad return for a month and a half, isn't it? If you annualize that, you'd be happy with it. So, yeah, there's been a lot of headlines, a lot of sort of question marks, but overall the S&P is up. The bond market, I think, is the interesting one. So 10-year Treasury yields started the year at 4.57%, so just a little over 4.5%. And as people are thinking about the pro-growth, the deregulation, that could lead to higher yields, shouldn't it? That if growth is higher. And we did see yields go up to about 4.8%, so down from just under 4.6 up to 4.8 in the middle of January. And now they've come down again as that sort of uncertainty and focus on some of the more, I guess, confusing parts of the of what he might be doing in terms of tariffs. That's come down to 4.5% as I said, the 10th of February. So it's been a bit of a round trip, gone up, come down. It's a little bit lower than where we started the year. So that's how bond markets are looking at it.
So before he took office, President Trump signposted pretty clearly that tariffs would be an important part of his agenda, and that's proved to be true. While those 25% tariffs on Mexico and Canada have been put on ice for now, the 10% tariff on China has gone through. Can you talk us through the practicalities of how this is going to play out and how significant it will be for the US and for the global economy?
Yeah, so China, so as you say, the only big one that's been enacted so far, put in place, has been that 10% increase on China. So, okay, so before that decision was made, the weighted average tariffs on Chinese goods coming into the US is about 15%. I mean, it's not an exact size, actually. So it was 15%. With the extra 10, it goes up to 25%. There's also a question mark in terms of small packages coming into the US. Now, anything worth less than $800 previously wasn't tariffed at all. And now President Trump wanted to remove that. He's had to back away from that, I think, temporarily, just because it's hard to open up all these packages. There are something like, it's hard to know exactly official, $50 to $100 billion worth of these small packages. I guess, all these like little things that you might buy on various platforms coming from China. So that again, if that is tariffed, it was from 0, and now it could go up as much as, I don't know, 25%, depending on what it is exactly. So that's, that could again increase tariffs. So from a I guess a China perspective, that's not good news. Funnily enough, though, Chinese equities have done really, really well. Well, at least the Hang Seng has so far this year. I mentioned the S&P was up 3% or so far this year. The Hang Seng here in Hong Kong is up 7%. Onshore equities are down a little bit, 1%, but it's not exactly a catastrophe, is it? And I think part of that is because, one, the Chinese retaliation on these tariffs were not that big. So China had put in place some tariffs as a result, just, I guess, as retaliation for what the US has done, but much less than what President Trump has announced compared to the initial tariffs when President Trump was in power the first time around. China basically sort of recreated exactly the same dollar amount in terms of retaliation. This time around, it's much smaller. Secondly, I think that what you mentioned about Canada, Mexico, deals were done pretty quickly, weren't they? Maybe there's hope that deals will be done between China and the US. Yeah, and thirdly, I think the fact that it's not just China that President Trump is going after is a bit of a relief. That was the concern. It was going to be all about China. President Trump has, of course, spoken about Mexico, Canada, was talking about Colombia, talking about the European Union. He's also put in place some tariffs more broadly in terms of some commodities, hasn't he? So the fact that it's not just China has been a bit positive. So it has been a focus. The 10% on China hasn't been great, but it's better than perhaps could have been the case, better than was feared.
Turning from global trade to matters close to home, at least for me, last week the Bank of England cut interest rates by 0.25% to 4.5%, and also halved its growth forecast for 2025 to 0.75%. Now, I understand that the detail of the vote decision was a bit more dovish than expected, with 7 voting for those 25 basis points and 2 urging for a bigger 50 basis point or 0.5% cut. But some of the messaging from the bank after the decision emphasised the need for restrictive policy to anchor inflation expectations. What have gilt markets told us about expectations for interest rate policy?
You're right. The original announcement was taken as potentially a bit more dovish. Like, well, there was a chance that they might have cut 50 basis points because 2 people voted for it. And one of the people that voted for the 50 basis point, Catherine Mann, is seen as a little bit on the other side. Normally, someone that didn't want to cut interest rates, so it flipped all the way to cutting by 50 basis points. But when you dug into the detail, and you can look up speeches by Catherine Mann, I wouldn't want to speak for her, but it sounds as though she just wanted to do that 50 basis points to get us down to a level, and then probably not cut by very much after that. So it was a sort of one and done. So whereas, we think the Bank of England, we're forecasting this year that they cut another 3 times by 25 basis points. So we think that they will continue to chip away. Perhaps Catherine Mann was talking about just doing 150 and then stopping. So it not actually as dovish as it looked. And as you say, they also cut growth targets. The rhetoric was talking about a gradual and careful approach. So it doesn't look as though they're going to be accelerating their rate cuts or doing lows. Like I said, we think probably they just do 3 more this year. Gilt yields have done similarly to Treasury yields in terms of a bit of a sort of went up and then came down again. The 31st of December, the start of this year, gilt yields were pretty much where Treasury yields were, sort of 4.57, 4.6%. They went as high as 4.9, and now they're a little bit below 4.5. So they've come back down again below 4.5. Quite similar to Treasuries, a little bit higher amplitude. I mean, I know we were talking, everyone was discussing high gilt yields in the middle of January. Like I said, they did get up to 4.9%, which was a multi-year high for 10-year gilts. I know longer dated gilts were even higher on a historical basis. But as I said, they seem to have recovered quite a bit. And that's on the back of lower inflation data that we've had out of the US and in the UK, some weaker growth. So that's a good sign, I think. It's allowing the central bank to support the economy, to support markets by cutting interest rates. So overall, I think that's been a positive development for the UK economy.
Arguably, another example of mixed messages recently has been the Magnificent Seven of US tech giants, which have been announcing their earnings results over the past week or so. I'm saying mixed messages because it seems like a mix of earnings that haven't quite lived up to, admittedly, very elevated expectations, and spending plans that would make Jay Gatsby blush. Is that a fair summary?
Yeah, exactly. The Magnificent Seven. So whenever I try and list the Magnificent Seven, I always forget one. So I've written it down. So it's for people who I think everyone would probably know, but it's Apple, it's Microsoft, it's Nvidia, Amazon, Alphabet, which is basically Google, Meta, which is basically Facebook, and Tesla. So those are your 7 stocks. They've all announced results in the last couple of weeks for Q4, except for Nvidia. Nvidia has a slightly different end of quarter. So there we've got to wait till the 26th of February for Nvidia. As you say, pretty much all of them, so take Nvidia out, so the other 6, haven't had a great performance after announcing results. There's a mixture of slightly disappointing numbers and elevated expectations. It's a bit like what I was saying about China in reverse. People in China investors in China were just worried what President Trump might do. So the fact that he didn't do too much was a relief. But investors in the Magnificent Seven are hoping for amazing stuff. So if it just comes out as good, then it's a bit disappointing. So yeah, we have seen a little bit of a correction, and the S&P up 3%. Actually, the Nasdaq, which is the technology index, which a lot of these names I think represents, has done even less. It's still up, but it hasn't done even as good as the S&P 500. I think what you mentioned though is interesting about capex. So DeepSeek, which is the Chinese artificial intelligence large language model, which has caused a few headlines, hasn't it? Because it's able potentially to do what some of the more expensive models can do with using less capital. That already sort of alerted people's attention to perhaps, maybe you don't need to be spending the amount of money that you've been spending in the past. So lots of these companies are spending loads of money on their infrastructure, their capex, but that doesn't seem to be putting them off. It's we reckon that in 2025, these companies are going to be spending $300 billion on capex, just in sort of spending on capital this year. Whether or not that works is the big question. I mean, people are hoping that you're going to spend it, and that means that you're going to earn loads of money in the future. One thing that you can look at is is investing in the reciprocity, the receivers of this spending. So, I mean, Nvidia is obviously one place where people are spending a lot of money buying their chips. There's lots of others as well. So, maybe to have a look outside the Magnificent Seven and look at where they are spending the money. Those are definitely companies that are making big sales these days, isn't it? So that's one way of looking at it.
A sort of picks and shovels approach to the tech sector, I suppose. So while the tech giants haven't been setting markets alight since the start of the year, European equities have delivered solid gains. What's behind their recent run of good performance?
Yeah, Harry, you're sort of spotting a theme, aren't you? That it's basically the reverse, almost the reverse of what people expected at the start of the year. Everyone was worried about China. China's doing okay. Everyone was very positive about the US and the Magnificent Seven. They're doing a little bit less good. And Europe, Europe started the year, again, lots of people were a bit worried about growth, about politics. And it's not as if everything's totally fine today, but again, it's beating a low bar, and it's allowing, so the Euro stocks is up nearly 10% this year. So again, that's doing even better than the Hang Seng, and again, a lot better than the S&P at 3%. So, and why is that? Okay, politics. So France, which has been trying to get a government together, trying to pass a budget. The latest prime minister seems to have managed to get a budget through parliament without losing his job. Again, that's a pretty low bar, but that's been a relief. We know we got German elections on the 23rd of February, increasing discussion about whether or not they get rid of their debt brake, which has been holding back some fiscal spending. If they manage to spend more money in the future, that's positive for growth. I mentioned before, Ukraine, Russia, still a pretty terrible situation. Maybe there could be hope of a ceasefire. If that happens, then you're going to see, I think that would be good for European equities. And then, of course, you've got valuations, which were relatively low at the beginning of the year, cautious positioning, all these things that I said. That just allows you to outperform from a lower level. Now, that's fine in the few weeks, couple of months. You can always push against consensus, and that seems to be what happens. To give yourself longer term momentum, you do have to see some fundamental improvements. So we would like to see a proper French government enacting some of the budget, and that actually having some legs. We'd like to see in Germany some growth, better growth. It'd be lovely to see a ceasefire in between Ukraine and Russia, of course it would. And so, it's all well and good where we got to now. I think to get the next leg, we're going to have to see some actual proper fundamental improvements.
It's reached that part of the podcast again, Ben. What's your number of the week?
My number of the week is $3,000, because that's where gold is rapidly heading to, isn't it? That's it's not yet. Well, we're going to publish this on Thursday, so who knows? But as of Monday's close, it was 2,907, according to my numbers. So not quite there, but who knows? And I say that, it's lots of people are gold bugs, aren't they? Just love it and can't stop talking about it. I'm not one of those, but I do have a soft spot for it, and I do look at sort of valuations and what's been driving it up until basically the Ukraine-Russia conflict. You could model gold pretty well using dollar. It's valued in dollars, so that's an input into it. But also interest rates. Look, it's a sort of store of value is gold, isn't it? But without a yield, it just sort of sits there doing nothing. Whereas if you buy a bond, you get a yield. So generally, if yields are going up, people don't like gold as much because they'll just be buying, they might as well buy the treasury. So higher yields generally lead to lower price in gold. But over the since the Ukraine-Russia conflict and the inflation spike that we've seen in the world, yields have been going up, and yet gold's been going up as well. So what's going on there? It seems to have broken down that historical relationship. Well, maybe it's becoming more of an insurance product for global central banks that have seen what's happened to some of Russia's assets, and the US throwing their weight around in terms of taking away the ability to buy treasuries. So if you're not allowed to buy treasuries, or you risk getting them taken away from you, maybe something that you can just hold on to physically has a higher value. And that's probably some of it, to be honest. That is probably some of the value going up. So you're talking about insurance, you're talking about a store of value that's away from maybe other governments. And that seems to have led to the price. To be honest, maybe it's also just speculation. Maybe it's also the Bitcoin price going up too. So who knows? It's a complicated topic. As I said, there's plenty of people that will bore you for hours. So at this point, I think I will stop.
Okay, well, we'll see if gold hits that $3,000 mark by the time this podcast comes out on Thursday. Thanks, as always, for talking to me today, Ben. And thanks to all our listeners as well.
As a reminder, this podcast is intended for investment professionals only and shouldn't be shared with a non-professional audience. The views expressed in this podcast are those of Legal and General Investment Management Limited, as at the date of publication. This podcast is for information purposes only, and we are not soliciting any action based on it. The information discusses general economic, market or political issues and/or industry or sector trends. It does not constitute research or investment, legal or tax advice. It is not an offer or recommendation or advertisement to buy or sell securities or pursue a particular investment strategy. Assumptions, opinions, and estimates are provided for illustrative purposes only. There is no guarantee that any forecast made will come to pass. No party shall have any right of action against Legal and General in relation to the accuracy or completeness of the information contained in this podcast. Where this document contains third-party information, the accuracy and completeness of such information cannot be guaranteed, and we accept no responsibility or liability in respect of such information, not for distribution to any person resident in any jurisdiction where such distribution would be contrary to local law or regulation. Copyright 2024. Legal and General Investment Management Limited is authorised and regulated by the Financial Conduct Authority. In Hong Kong, this material is issued by Legal and General Investment Management Asia Limited, regulated by the Hong Kong Securities and Futures Commission. For full terms and conditions, please visit our website. To find more content, you can check us out on X, formerly known as Twitter, LinkedIn, and our website.